Vandaag is bij mij te gast Sam Wilkin. Hij is Oxford-econoom en auteur van het boek The Wealth Secrets of the 1%. Inmiddels is het ook vertaald in het Nederlands met als titel Heel veel geld. En hij was in Nederland waar ik hem interviewde over de geheimen van de mensen die heel veel geld hebben. Hij heeft lovende kritieken gekregen, onder andere van de New York Times.
You know, I tell some of the stories of the richest people in history and in the modern day and how they made their money. But if I was to summarize, I mean, everything in the book is kind of based on economics. I'm an economist. It kind of comes down to economic principles in the end. And everything really comes down to one of two possible ways of making money. First is to get some kind of monopoly, and the second is to take risks without paying for them yourself.
Is it a bit like Warren Buffett did with Berkshire Hathaway? He used other people's money, money from the insurance company. He invested it with Berkshire Hathaway and he made a fortune.
Right. Well, that's a very good point. Buffett is actually someone whose wealth secret is very hard to understand because, he's actually sort of operating as an investor in a very competitive kind of industry. Like, so many people have been interested in Warren Buffett over the years, right? They all travel to Omaha, they listen to this guy, the sage of Omaha, and try to figure out what he's doing. So the amazing thing is that no one seems to have figured out what he's doing after all these years, or else they would pick the kind of investments that he picks before he picks them, and then all that kind of value that he exploits would be competed away. So one thing I say in the book is maybe the wealth secret of Warren Buffett is that he knows about wealth secrets. And indeed, if you read a lot of the things that he's written, he talks a lot about monopoly. He calls it a moat, but it's a lot of this is means to getting kind of monopolies.
I also see Warren Buffett not only as an investor but also as an entrepreneur.
No, absolutely. And he's really clear, and this is the advantage that one has as an investor, right? If you're an entrepreneur and you start out just building your own company, then if you pick the wrong sort of industry, an industry where it's really hard to get a monopoly advantage, or if you pick the wrong sort of industry, then almost nothing you can do can make it work, right? Buffett, in one of his books, he gives the example of a textile company. Textile company was the best in the industry. It was well run. It was really aggressive. They invested a huge amount of money, very dynamic, made all the right decisions, and they still went bankrupt over the end because the textile industry just vanished from America. It was too competitive. It wasn't. It couldn't compete with the onslaught of international competition, especially from China. And so he makes his point. He's definitely an entrepreneur, but he's also an investor in that he picks a company, definitely holds it for the long term and improves it. But he picks a company where there's a sort of monopoly advantage, like Coca-Cola, famously with its brand. That brand is protected by the government, prevents you from making any kind of beverage, Coca-Cola. So that's a kind of monopoly advantage. And then he tries to extend these advantages by good management.
Okay, so monopoly and patents are very important if you want to be very rich. But what about luck? I read your article about Donald Trump, how he get rich, and if instead he not invested in New York City but in Detroit, then he wouldn't be as rich as he is now. So what is it about luck?
Well, one thing I can tell you almost certainly is that Donald Trump would not say it was luck. He would take full credit for that decision. And to be fair to Donald Trump, he was very clear in his belief that New York was a winning story, and indeed it was. Property prices. He kind of went into New York in the early 1970s, 1973, 1974, and property prices in Manhattan as a whole, average property prices in Manhattan increased by about 6,000% between 1973 and the present day. Absolutely enormous increase. And so one thing that's definitely true about Donald Trump is, he makes a big deal about the art of the deal, says it's all about making deals. Of course, nothing to do with making deals. Anything he bought in New York was going to see that kind of return. So it really didn't matter whether he had a good deal or a bad deal. He just had these kind of amazing returns. So it wasn't necessarily luck. It was definitely risk. His father had made money in a classic wealth secrets kind of way. He'd actually exploited a very poorly designed government program to make his money. And so Trump inherited control of a company worth close to $1 billion in today's money back in the 1970s. And so he had a lot of money to play with. But what Trump's father had done was he had done what they tell you to do in business school, or what they would tell you to do as an investor. He had started to diversify, right? He had started to build housing or invest in housing in the Midwest, in California, just getting away from just a New York focus. And Donald Trump totally reversed that decision. So very deliberate decision, and threw it all into New York. And I do make the point that if he threw it all to Detroit, he would now be wiped out, but it did pay off. He had good reasons. He took a lot of risk with a lot of money. So, rather than the art of the deal, he should have called his book, The Art of Taking a Lot of Risk with a Lot of Money. That would have been a more accurate, although perhaps less exciting title.
One famous quote is that it's also very important to be in the market. So it's not all about timing the market, but it is time in the market. So you can profit from the compounding.
Absolutely. We would all be billionaires if we only had enough time. If you start with about $10,000, and you invest at a standard rate of return, 6-7% real rate of return, you can be a billionaire. I think it takes you about 300, 400 years. I calculated it out at one point, just out of curiosity. Unfortunately, except unless you're, an eternally living vampire, that kind of thing really doesn't pay off. Or if you pass it down, generation to generation, that kind of thing really doesn't pay out. What does work for, though, you may have noticed that about a quarter of the largest fortunes in the world are technology fortunes. So the top 20 billionaires, 5 of them are technology billionaires. And one reason why they are so dominant is because they get rich young. And that means their wealth has plenty of time to compound. So actually, you may have seen that Mark Zuckerberg, he gave away a lot of his money. And frankly, he probably had to do that because from the amount of money that he has now, by the time he hit retirement age, he'd be pretty close to being a trillionaire. And I don't think the world is ready for a trillionaire yet. And he starts to face lots of political problems. So I think there's a good reason for him giving away his money. But you're absolutely right. It really demonstrates the power of compound returns.
I once calculated that everybody can become a millionaire if you start soon enough. I calculated for my children that if you invest 2,000 euros, the first 2,000 euros will be almost 1 million. And everybody can be a multi-millionaire with 167 euros a month. So start early and keep going for about 65 years. That's what I calculated.
Yes, you have to keep it going, really for generations in order to make that work. It does work. This is one of the issues the French economist Thomas Piketty, he made really famous that inherited wealth is becoming really dominant in continental Europe, but that goes back to the point you just made. It really does work, this kind of compounding interest. There is another aspect in which timing is really crucial, and that is that Buffett and this is kind of the amazing thing about Buffett, is that Buffett has somehow managed to pick up these companies with monopoly advantages at a time when other people didn't recognize those advantages. So, your difficulty, even if you get the right company, as an investor. You find a company that's got a monopoly advantage and is going to be really, really successful. Problem is, other investors are probably be there already, and you're paying a very high premium for that. But Buffett somehow managed to get in there at a time when there wasn't that kind of premium, and therefore was able to make a lot of huge returns off of his investments.
Warren Buffett always talks about the margin of safety when he buys stocks. But I always find it risky to buy stocks when it's going down. I prefer to buy stocks when they are in an uptrend. For instance, look at the banks. They keep going down, and where will it end?
Because the banks, a lot of their success, as I talk about in the book, a bank is a factory that makes money, right? They take money in, they put money out, and they make money in differential. And a lot of the success of the largest banks, and the largest banks tended to be the most profitable, a lot of the success of the largest banks was due to sort of an implicit government support. And that really reduced the cost of funds coming in, because people were sure the bank was going to be stable. So they were, even if the bank took a lot of risk, they were willing to give the money to the bank for cheap. And so that difference of like cheap money coming in and expensive, risky behavior on the other side, that was profit, right? And that really made the banks a great investment for people. It made the banks do really well. The question you have to ask yourself now as an investor is, do you believe those days will come back? And politically, I am not sure, because certainly the banks still have implicit government support, but the European regulators especially, US regulators less so. We haven't really addressed the issue so much in the US, but European regulators have really cracked down hard on the banks. So that goes to your point of, is this the bottom? I mean, I don't expect that banks may go down too much further, but they may not go up if they don't get back to that rate of return that they were able to achieve under that really much more easy regulatory regime. It's political risk,
So no more 363 for the banks.
Well, so that used to be the way banks worked. I mean, at the time, banks didn't make too much money, but it was get funds on deposit at 3%, lend out at 6%, and then at the 3 p.m. head off to the golf course. And that used to be the way banking worked in the United States. It was boring, didn't make too much money. There was also a really big risk, and it's a topical risk, because U.S. interest rates are about to rise. It is a very topical risk. So what happened in the 1980s is U.S. interest rates rose, right? And banks, especially savings and loan, they were living on this something like that 363 rule still. Then what happened is they are mostly making mortgages. This is especially true of the industry in the United States called the savings and loan industry. And they were mostly making mortgages. And those mortgages were on fixed interest rates. And so they were getting those interest rates kind of locked in. And then US interest rates rose. So suddenly, in order to attract depositors, they really had to raise the interest rates they were paying out. And so pretty much the entire industry collapsed. There's almost 100 bank failures a year during the middle of the 1980s. So that's one thing you really have to watch. Now that US interest rates are shifting from low to high, is there going to be when you're making your investments, are they going to be affected by that kind of thing? That's a real macro risk.
And what do you think about the new technology with the crowdfunding and the blockchain technology? Will this be the end of the banks?
Well, that's a very good question. A few years ago, we were working on a big report for one of the big professional services firms looking at the future of banking. And we said, new entrants disrupting the banking sector was a big risk. And the banks at the time said, no, it's not an issue. Now it really does look like an issue. The thing about these kind of disruptive businesses is that when they're entering a really regulated sector, they can run into trouble. Like we've seen this with Uber, right? Uber is really disrupting the vehicle hire industry, basically the taxi industry, really disrupting the taxi industry. But the taxis industry has a lot of regulatory clout in many places, especially in Europe, not just Europe, but many places. And we've seen real regulatory risks for Uber. I'm pretty sure that these startup financial firms, even really innovative ones, are going to start running into some regulatory issues if they get big. So it's not, an open and shut case. In one sense, they're not really disrupting industry. What they are doing is disrupting regulation. So the taxi industry wasn't very competitive before Uber entered. It could have been, but it wasn't, because they limited the number of people who could run taxis, and that restrained competition. So Uber actually didn't really improve the service all that much. It has improved the service, but the main reason it improved the service was because there was that regulatory barrier that prevented other taxi services from, offering, cheap and good services. And so, fundamentally, some of these disruption things are not about doing the business better. They're about like the regulatory, changing the regulation or going around the regulation. And that means they face a huge amount of regulatory risk. So something to be very careful with in kind of startup investment.
And what do you think of the new technology with Airbnb, which disrupts the hotel market, Uber for the taxi market, etc.? Do you think there are new concepts coming which will disrupt and challenge the status quo?
Absolutely. There are a lot of industries that are kind of ripe for disruption. You mentioned, I think, some of the main ones, but absolutely. The thing that makes it so powerful is the economics of these disruptive businesses are very different than the economics of what they're replacing. And the reason for that is something called network effects. A French economist called Jean Tirole won the Nobel Prize in economics a couple of years for explaining about how these work. If you want a really detailed, intense explanation, my book also has an explanation more entertaining, but less detailed. Bill Gates understood network effects back in 1981. He said, I probably shouldn't say this in public, but this is a natural monopoly business. And that is the key. Basically, the way these network effects businesses work, these kind of disruptive technology businesses work, is the bigger the network gets, the more valuable it is. And that right now, economists don't know too much about this, a very new phenomenon, but right now it appears that increases, that advantage from having a bigger network, that increases without end. So that means there will be one player, usually, that one player will dominate the whole industry. That makes investors very eager to get in and bet on this future monopoly, like Uber, like Airbnb, like the ones that are disrupting finance, other industries, because they think there'll be one player that really wins. That means it's incredibly easy. That's why these companies are becoming unicorns with huge valuations, because people are betting on that monopoly future. The one cautionary tale I would say here is, are monopolies going to be politically sustainable in the long term? It's again coming back to this regulatory risk I mentioned. Google right now is facing a big antitrust action in the European Union. If Uber really did become that kind of transport monopoly, are they going to be allowed to continue like that? I think, maybe that's a problem that you don't have to worry about for another decade, maybe even 2 decades. But it is a problem. So if you're thinking about your kids' retirement fund, make sure you have a way to exit the investment as well.
And also to diversify, because everybody was convinced that banks would never fail.
Yeah, exactly. You can get amazing, like Donald Trump, you can get amazing returns by putting all your eggs in one basket if that basket happens to be full of golden eggs. But it is really risky. You have to be crazy like Trump, and Trump does seem to be crazy. So there you go.
Aren't you concerned about the growing gap between the rich and the poor? Because this can create instability within the economy?
That's true. That is something that I was sort of alluding to earlier, in that a lot of the way these industries are being reshaped is they're being turned into industries where there's one winner. That already started with, back in the day with Microsoft, with Bill Gates about the natural monopoly. He understood that there was only going to be one winner. And that does create a lot of inequality, because one person's success story, like Bill Gates' success story, is then inequality for a lot of other people who kind of got wiped out in their early stages. It used to be that industries were more like, if you think about the Apple iPhone versus Android, there are a lot of people making, that used to be the way things work, is the Android way, I guess you could say, where there are a lot of competitors in the market and they divided the market, like the Android phone makers divide up the market. But increasingly, industries are more like the iPhone, where there's one winner, and that means there's a lot of losers. So you're right. There is a lot of there is definitely rising political risk. Trump is just one example of that rising political risk. Brexit, is another example, and that's posed some real issues. The dollar pound volatility has been recently higher than at any time since the European sovereign debt crisis a few years ago. So it's definitely a risk.
Yeah.
What do you see as the most interesting investment opportunities for the coming years or coming decades?
What I would say, and then most of what the book is about, is figuring out what is it that makes these particular businesses, particular billionaires, particular businesses really, really successful, and like looking into why, the economics of why they were so successful. And really the key is to identify, as an investor, a company that is going to have that kind of some monopoly advantage before anyone else realizes it, right? After everyone else realizes it, you're just paying a high premium for that company. You have to get there before everyone else. And so I think that's the key. It's not something that I can tell you the answer to. If I did, I would I would invest on it myself, and I would definitely keep it a secret. But honestly, it's not something that I'm a macroeconomist doing the economic outlook. It's not something that I'm a specialist in. What I can say is, what's key is figuring out before anyone else does. Often it means doing things that are quite counterintuitive. So, for instance, I talk about in the book this fellow Dhirubhai Ambani, a guy who was born as the son of a school teacher in rural India, and his son became the richest man on earth in 2007. And that's the kind of rags to riches story that you just would not think would be possible in the world. You would just think it could never happen. It did happen. And the counterintuitive thing that he did was he was doing business in India, which was already a pretty hard place to do business. And then he did business in the most difficult sector of the Indian economy, which was textiles. It was hugely regulated by the government. Only small businesses were allowed to enter the sector, which meant that you couldn't build a fortune. You couldn't make money in the sector because you had to stay small. And he figured a way to get into textiles and get around that. So he picked the absolutely most difficult, worst place, perhaps on earth, to start a business. But he knew he was thinking 2 steps ahead, right? He knew that if he did that, then no one would be able to come after him. And that's what makes it worthwhile. A lot of people, they think about, how can I just be successful and make some money? They don't think the second step, okay, once I start making money, how can I make sure nobody comes after me and starts doing what I'm doing? So I think there's a lot with the emerging markets really crashing right now. I think there's a lot to be said for with that kind of strategy, trying to find a sector where it's really an unpromising sector. The market's really down, but there's like a company that has the possibility to dominate that tiny sector. Sort of the Dhirubhai Ambani approach to investing, to be separate from the Warren Buffett approach to investing, right? The Ambani money approach is really picking a sector, a company that's in a really difficult place, but has a good chance to dominate it, which means they're likely to face less competition in the future.
As a private investor, you're always in a disadvantage because you have to compete with the big banks, the big brokers, with the smartest people, with the biggest computers, with whole teams. So why not just follow the trend instead of trying to outsmart the large investors?
That's a very interesting point. I mean, I do think, yes, if you're trying to achieve a kind of a moderate rate of return, like a good rate of return, but sort of a reliable rate of return, something along the 5 to 10% range. You mentioned 10% earlier, right? So if you're trying to get into that rate of return, I think that is a good strategy. There is a company called Morningstar, which is a US company. I'm not sure if it has operations in Europe. They have this thing called the Wide Moat Focus Index, which basically tries to put Warren Buffett's idea of a moat into operation. And they pick companies that have these characteristics that I would call kind of wealth secrets. They pick these companies and they try to get you to invest in these companies at a time when they're comparatively discounted. The returns are not great, let's be honest. You're not going to see like Trump returns from these kind of things, but they are pretty good. And that's kind of an idea, that's also trend following, where you're kind of picking these companies that have done really well in the past. They have a really monopolistic position, and they're solid companies. And your key is to get in at a time when they're a little bit undervalued. And that can get you a solid long-term return. Now, if you're trying to get the kind of Donald Trump returns or Dhirubhai Ambani returns, you have to do something, or Bill Gates, you have to do something a little bit different. You have to put more eggs in one basket, and you have to get that monopoly position. The company that's going to have a monopoly position before anyone else knows about it. That is a lot riskier, and more difficult.
There is a positive correlation between age and assets. And when people are getting older, they don't want to take too much risks. And when you look at the stock market, only 6.1% of all the stocks can dramatically outperform the index. So isn't it smarter than just to follow the index and diversify instead of trying to get just the 6.1% of the stocks who will dramatically outperform the index?
Yeah, well, Peter Thiel advises, he's a billionaire investor in PayPal and other kinds of .com companies, kind of a controversial guy because he sort of admitted that, these businesses are monopolies and it's kind of risky thing to say in public. But he says that, you should invest in, if you think you're going to have an industry that's disrupted and you think the case is really good for a disruption, then invest in a ton of companies because one of them will be the monopoly and you don't know which one. There's no way to predict which one. So, you have to do this kind of, even for a venture capitalist, you have to do this kind of very different style of investing than you used to do in the past. For myself, what I tend to do is I have my pension fund and very safe kind of assets, and then I have a little money set aside for gambling. It's gambling, I know it's gambling. My day job is looking at how the global economy shapes up and emerging markets investing. So my gambling is picking out emerging markets that are going to do really well, economically speaking. That is, I enjoy that. It's entertaining. Sometimes I get amazing returns. I invested in Ireland during the European sovereign debt crisis. I got a great return off of that. But a lot of times it's really hard to foresee because you're trying to foresee not just the economic performance of the countries, which I know a lot about, but like what's going to happen with U.S. interest rates and global capital flows have nothing to do with economic performance of the country and really move markets. And that's always your challenge as an investor, is you're dealing with, in Europe, you're dealing with quantitative easing, and will there be more quantitative easing, as most economists think, or will there be less quantitative easing, as the company I work for, Oxford Economics, as they think? So you have to keep those macro factors in mind too.
In my experience, a lot of economists have money, but not every economist is a billionaire. So understanding the economy is not a recipe to make a lot of money.
I don't think so. Yeah, we're very good at explaining, why things happen and how they work, and that's what I try to do in the book, is explain the economics of, why these businesses are really successful. But in terms of like having that insight into company management and where the market timing and all those things that you need to really pick the winners, that's not what economists are very good at in most cases. Some are.
What do you think the ECB can do to get us out of this crisis?
Well, to be honest, I should say this is my own view, not the view of Oxford Economics, a company I work for. But to be honest, I actually think it may not be necessary for the European Central Bank to do any more kind of unconventional policy. Admittedly, there is a big problem with deflation. More and more countries are getting into a very low inflation situation. But there is, I think, that we're sort of on the cusp of a turnaround, especially with wage inflation. So I think German wage inflation especially is about to take off. So
I want to ask a question about economies of scale, because there are now a lot of companies which have a dominant market position, like Google, and the next search engine, they don't play a large role. Do you think that the number 2 and number 3 companies, they still have a future?
A huge issue where, no matter how well run your business is, you're competing against the economics. And so, people often look at, Bill Gates and they think how amazingly rich he is, and they try to find some reason that he's kind of superhuman, that he read the World Bank encyclopedia, read the encyclopedia cover to cover when he was 9 years old, or that for fun he memorized the license plate numbers of every Microsoft employee. They look for some reason he's superhuman, but he's not superhuman. What he's got the economics on his side, which means that, as you say, economies of scale, for the number 2 industry, even though they may be almost as good or even in some respects better than Microsoft, the economies of scale mean that it's virtually impossible for any of those businesses to compete. But one thing I would say is that economies of scale, you don't have to just look in these kind of .com businesses, right? Like if you look, the Netherlands doesn't have too many billionaires. It's a relatively small country, and maybe oriented with international trade, which is really hard to make a huge amount of money. You can make good money, but not hard to make a huge amount of money. But a lot of the Dutch billionaires are in really kind of heavy industries, like shipbuilding. There's one in shipbuilding, one in autos and buses, one in chemicals. And why is that? Well, these were companies mostly that were started quite a while ago, from the 20s to the 60s. Netherlands is a pretty small country. These are industries where you need a giant factory in order to operate in the industry. And so basically, if you get scale, if you start to be the biggest one, you're going to be the only player, right? How many shipbuilders does the Netherlands need? How many auto and bus companies does the Netherlands need? There's going to be one company that dominates. And most of these fortunes are fortunes that were started as second generation now. So they were started at an earlier time. Now you would face a lot of global competition, but there's still a lot of cases like that out there in the world, where there's a small-ish market, but still lucrative, and you can be the big player. So, for instance, there's a port in New Zealand, which is fabulously profitable, because New Zealand isn't big enough to need 2 ports. There's only ever going to be 1 port in New Zealand, and so it's going to make a lot of money no matter what. So you're kind of looking for that it's not just scale relative to the world. I mean, for some of these tech companies, it is scale relative to the world, but it's mostly scale relative to the market that you're in. Like, in the scale economies can really work for you in those cases.
Due to the globalization, the wages are no longer rising, and we now have to compete with people in India and China. What can the Western countries do to compete with those countries?
Oh, well, that is a good question. I mean, the classic, response has been, of economists has been, well, you need more education. Right, that's the competitive advantage that you have. Basically, what technology, advances in technology and globalization as well have done is they've increased the returns to education. So basically, now having more education is really crucial to having a higher income, and having better education is really crucial to having a higher income. So you're thinking about what to tell your kids. That's definitely a key message. And the other thing is, and this is why I wrote this book, the playing field has got a lot less level. It is a lot more unfair than it was even a few years ago. In the 1960s, about 1% of companies were making returns on investment, internal returns on investment of 50% or more, or 50% or more. Now, that figure is about 14%. So there are a lot of companies that have kind of an unfair advantage, maybe from economics, maybe from regulation, from a lot of different reasons. And that's the reason I wanted to write this book, is to level the playing field a little bit, to let people know what's going on, that the world has changed, and that if you want to really succeed, you may need to think about not just getting a good education, right, but also thinking about like where you go into, so where there are these advantages that you'll have on your side.
The top 1% has about 40% of all the assets in the United States. And you cannot get rich from working alone. So what can you do if you want to become part of the 1% of the wealthiest people?
Well, I mean that is an issue. This is something that's been talked about a lot, especially kind of a concentration of wealth that's taking place. This will be an increasally political issue. Because of the compounding returns that you talked about, which are great for the individual investor. But there is a point where the compounding returns for people who already have a lot of money are so large that there comes a point where you really can't catch up, no matter how hard you work. And the economist Thomas Piketty, I don't know, he has a book, very famous book now, Capital in the 21st Century. Most people, bought the book and then never read it. But if you do read it, there are a lot of interesting stories in the book. And he talks about how in the late 1800s, people would give each other advice, or the novelists would have advice, like, look, don't try to work hard, there's no point, because you'll never catch up, you'll never be one of the richest people, because people's money is they already have so much money, and that money is compounding so rapidly, so there's no way to catch up, so he said. And that is deeply worrying. It's a deeply worrying kind of political trend. It does, again, to go back to the first point you made, it does underline the importance of compounding wealth and getting started early, especially in investing. But it also will pose to us, to our societies, a really big political issue. I think the obvious thing that's going to happen is taxes are going to go up a lot.
Interesting. Because Warren Buffett is complaining that he's paying less tax than his secretary. Do you think this will change?
I think it will change. For a long time, so the Panama Papers were a really big story recently, right? For the long time, tax havens existed, and frankly, the existence of tax havens partly is down to the tax haven, but mostly it's down to the regulations in our countries where people allowed money to go out to tax havens very easily. And that regulation was, it was in place because I think a lot of cases, people who made the laws were kind of, it's kind of convenient to be able to ship the money offshore, And so, and that, as you can see with how big the Panama Papers became, all these laws that have been cracking down on tax havens and like preventing people from, shipping money offshore and requiring tax havens to disclose information about who has the money. That kind of crackdown is new, and I think that's the starting point for a kind of broader, movement that will eventually lead to higher taxes. I'm sorry to say, if you hate taxes, I hate taxes, but I think that's the way it's going to go. There was a U.S. billionaire a couple of years ago who was, one of his TED Talks said, huge inequality ends in one of three ways: ends in wars, revolutions, or higher taxes. And despite Trump's rise, I don't see a revolution on our horizon, but I do think higher taxes are likely to be coming.
When you look at France, it looks like a revolution. You see more and more riots. People don't agree with the inequality.
It's interesting times.
Yeah, absolutely.
I mean, I think for an investor, you have to think about political risk in what you're investing in. Like, will there be a regulatory backlash against what you're investing in? Will there be a tax crackdown on the industry? We especially on the technology sector, we're starting to see a lot of these companies that are being forced to make now arbitrary tax payments, but I think they're going to be forced more systematically to pay a lot more of their income in tax.
But then it's the question if the taxes will be higher for labor or for capital. I read the book of Robert Kiyosaki, Cash Flow Quadrant, and he also states that on the right side of the matrix, the taxes are lower for investors and for companies, and on the left side, for people who work, they pay more tax. So it's better to be on the right side of the matrix than on the left side of the matrix.
That's absolutely true. I do think that is going to shift. The reason why it hasn't shifted and why it's so hard to shift it is because capital is mobile. I think he makes the point in the book. And now it's really mobile with companies like Google and Facebook, where all their money making is tied up in intellectual property. It's incredibly mobile. Like, you've had all these tax inversion deals in the United States. They could just move where they are headquartered and where their money is made really, really easily. So, it's true. It is really hard to do that kind of tax crackdown. It will require sort of international coordination, much easier in Europe than it is in other places to do. So I'm afraid if you don't like taxes, you probably want to get out of Europe. So I think there will be a shift towards more tax on capital.
Well, that's not good news, because I think there's a certain limit to how much tax you can pay for income. Here in Holland, 1.2% of your assets, and a lot of people say, well, we already paid taxes over our income to generate to get to the assets. So it's going to be a problem then to hire the tax on capital then.
I mean, I think, for the smaller investors, I think that they will, to some extent, escape this kind of tax crackdown, because it really is about this inequality issue that's been taking off, and by and large, I think will target larger investors. It does probably mean that, sort of tax-advantaged investments will, that kind of thing could shift. Again, it's a political risk that you have to keep in mind when you're investing. And it really, we since the end of World War II, we've had a pretty benign political environment. You really haven't had to think about politics too much as an investor. That is really changing, as we've seen in the banking sector, but it's going to be true in other sectors as well. So yeah, I agree. There are big downsides as an investor to this kind of regulatory change, to increases in taxation. But at the same time, I think it's pretty clear where the politics is going on this. So you have to also be sort of a realist. Yeah.
Another issue is, of course, the national debt. In Holland, it doubled in 9 years, and I'm concerned that when the interest rates go up, then because of the high debt, then we really have a problem.
I'm pretty optimistic about things getting sorted out. In Europe, in the United States. There will be some countries that won't make the transition. That's one other thing that happened. In the U.S., interest rates went up a lot in the 1980s. A lot of countries defaulted on their debt. About 15 countries a year defaulted on their debt through most of the 1980s. Most of them emerging markets, but still a lot of defaults. We are sort of heading into that world now. Venezuela will probably default. They are on the verge of either a humanitarian crisis or default. They kind of can choose. It's a hard choice, not a choice I would want to make myself. And I think they'll be followed by a few more countries. The good news, I would say, is that I do think, by and large, the Eurozone crisis has been resolved with risk of Brexit and that kind of thing. There is still Brexit risk. Portugal is kind of in a little bad situation now, but by and large, countries are now getting the rebound. Spain, Ireland, really enjoying rebound, despite the issues in Spanish politics. But they're economically really enjoying rebound. So I think we're getting back into the recovery phase, and we should kind of go back to a more normal rate of growth. And the good news is, here's some good news, there actually should be some wage inflation, starting in Germany, but moving to other countries. It really, most of the indicators look like there's going to be wage inflation because there's a lot of demand for new hires, unemployment at record lows, and people, this is in Germany, unemployment at record lows, and people having a hard time. So there should be, finally, labor, which hasn't enjoyed much of a good run for lately, they should have some good times ahead.
Well, I hope so, because I think that when you have a large debt, you need inflation to get yourself out of this mess. But we also have another problem here, and that's the demographics, of course. We have a lot of baby boomers, and they will get their money out of the pension fund. So that's going to be also challenging for the economy. So, what's your opinion about this? Because in Japan, they weren't very successful with this policy to create inflation.
They made an attempt to change the demographics, right, by allowing a lot of people. I think that was Angela Merkel, the German, almost a leader of Europe, Angela Merkel. He's really, I think she made an attempt to change that by allowing a lot of immigrants in. This obviously has now caused a backlash, but I think that is one solution. Robot, automation, another solution. I think economics tends to provide a solution. The good news about that is if you have this kind of shortage of labor, you should start to see inflation pick up. Now, I totally agree with your point that this did not happen in Japan, and the economists really don't understand the situation of deflation well, because we haven't had it since it was a big problem in the 1800s, but we haven't had a deflationary problem in a long time. And you kind of you run into the problem is overcapacity. There's a lot of industries that need to sort of shut down capacities, like steel, for instance, is a big problem, needs to shut down capacity globally. But when you reduce interest rates, that makes it easier for companies to keep on going, so the capacity doesn't get shut down. So, it takes a long time. It's really, and in Japan, they kept on bailing out companies. So you need to, they need to stop bailing out the companies. But I don't think Europe is making the same mistake as Japan, where they kind of prevented their own adjustment process by bailing out a lot of companies. I think you are seeing these companies being shut down. You are seeing this overcapacity problem being dealt with. You've got now unemployment at a record low. That should bring about a return to inflation. I admit I am a little concerned because we've not been here before, and you don't really know what's going to happen. But I do think that change should come about in the next year.
So you're still very optimistic about the future of the Western countries?
Yes, yeah, no, I am. And in Europe in particular, I think, one thing that people don't talk a lot about in the Eurozone crisis that happened is that as a result of the crisis, European countries got a lot more aligned and a lot more integrated, and a lot of these countries like Spain, Greece, Portugal were forced to implement a lot of reforms. And so the European economy as a whole got a lot more competitive. And so you should see that benefit. I mean, there was a lot of pain when it happened, but you should see that benefit start to feed through in some good results. Once the global economy starts recovering from the Chinese crash and all the trouble, and once inflation starts up again, so you should start to see some benefit from all the suffering that Europe has gone through. So yes, I'm definitely optimistic about the next few years.
Okay, thank you very much for this interview and for those positive view on the economy. Do you have some golden nuggets for those private investors, where to look for and where to invest in?
Right. Well, I mean, I think to an extent, people know about the economics of technology industries, so it's hard to find those gold nuggets in technology anymore. We know about it. It's hard to find them in finance, banking, because political backlash that's occurred. Where you still can find them, and where there should be a lot of gold nuggets right now, is in emerging world, in markets that people aren't really looking at, because pretty much every emerging market has crashed. And so there are opportunities definitely to be found. I mean, there's already been a bit of a rebound, but there's a lot of rebound potential in the emerging markets, just in the equity markets. And so if you get the right kind of company in a market that's going to rebound, you can see some real returns. The trick is finding that company that's going to be really dominant in a small market, or that's going to have tech advantage. Maybe the next tech company you really want to invest in is one in India, not one in Silicon Valley.
Okay, thank you very much. I thought it was very interesting. I want to invite everybody to read the book and leave their comments on beneath this video.